Namaskar. So, in this special series, year ender 2020 of BSE IPF, Year of a Crisis, Lessons of a Lifetime, we are trying to take out something from that once in a lifetime harrowing experience, the tumultuous ride which markets had in 2020. So, till the last session, 5 sessions are over. We saw how RBI provided liquidity and tried to soothe the nerves, but even then, even though RBI provided liquidity, not all stocks were suddenly or all bonds were suddenly equal. This crisis thought of segregating the good quality from the bad quality, so much so that even today, the good quality stocks, they are commanding as high as 80 or 70 PE, whereas there are some companies even in Indian markets which are still below their highs of 2019. So they never recovered after that crash happened of March 2020. So let us see what happened. Sensex stunner. RBI said liquidity is available. Global bank said liquidity is available. All that liquidity was finding its way into various assets. One of the countries where every investor was excited was India. A lot of forex reserves, our forex reserves came. Our forex reserves started increasing, in fact, so much so that America started saying that India is manipulating its forex reserves, now its currency level. Now, what does this mean? Because of this huge gush of global liquidity and because of India's position as perceived by foreign investors, money started flowing in. So dollars came in, rupee demand appreciated, and because rupee demand went up, and because of that, rupee would have appreciated. But RBI did not let the rupee to appreciate beyond a level. If we look at the chart of rupee dollar, if we look at the chart of rupee dollar uh, on a monthly basis, then you can see that somewhere around this level the rupee had fallen to as high as 77, sorry, as low as 77, and today as we speak, and even the year is yet to get over, we are at 73. So from 77 the rupee again started strengthening back to 73, and this strengthening America says is not enough. Rupee should not be 73, it should be probably 72, 71, something. So America is saying that India is deliberately not allowing the rupee to appreciate. It's capping because it wants to support its exporters. Now, because of that, what happened was our forex reserves went up, liquidity in the domestic economy went up because RBI just kept on buying those dollars and sterilizing the flows and kept sending rupees into the economy, and then that rupee flowed, and because of that, the Sensex from 42, first the Sensex was stunned when it hit this lower circuit of 25,000, 26, 25,000 and something more, and then it stunned all investors when it went to 44,000. So this entire 42,000 to 26,000 and 26,000 back to 44,000, and now we are, I mean, there are people who are talking of when it will it go to 50,000 before budget and all. So that is the kind of sentiment change, the drastic sentiment change that has happened, and that happened because of this huge liquidity that happened. Are these animal spirits? Is it irrational exuberance? There are doubts. The RBI governor also had cautioned investors that market has run ahead of fundamentals, but then for the moment that's what it is. Now, why this happened is, one of the fundamental reasons is high liquidity is equal to low cost of borrowing. Because there's ample of money available, yields have come down, and we will see that in one of the next videos. But this is why, and because low cost of borrowing is available, companies are making the most of it by borrowing from outside. So that is the ECB, external commercial borrowings. Now, which companies have gone up? Because there are some companies which fell more when the Sensex fell, and they never rose back when the Sensex rose. So there are some companies, and if you have such companies in your portfolio, you should ask yourself a question: why is your portfolio not moving when the whole world, each and every asset class is going higher? And if today your portfolio is not rising, then if you are not participating, because this is the time when wealth creation is happening at an accelerated pace, so much so that regulators are worried about the pace of the asset price inflation. And if your portfolio is having such dud stocks, then it's about time you rechecked, reviewed your portfolio. And if you don't understand anything, just go to index fund. Don't make the mistake of picking stocks and stuff like that. No, just go to index fund, do your daily SIP, daily STP, and that's about it. Because this is not the time when a portfolio should be sulking. Any portfolio or any stock, I mean, if only if you are having poor stocks will this happen. So you need to relook that kind of a thing, unless you are having some very value stocks which are not performing. That's a different thing. But there are some stocks which people may feel they are value stocks, but they are actually junk. So if you can't make out this difference, go to an index fund. Companies which are low debt are being given premium valuations. Companies which are high debt are being battered in the markets. There is ESG, that is environmental, social, and most importantly corporate governance. Companies, so in spite of having this huge liquidity, not all are equal, not all stocks are equal, not all companies are equal, not all bonds are equal. There are some companies which are attracting a lot of this liquidity due to their high previous performance. They are getting these sky high atrocious valuations, and there are others which are just not attracting any big institutional money. Why? Because they are not having good corporate governance. So if you are having any of these stocks where there is a corporate governance issue or where there is a high debt issue, then as long as this rally is there, even at a loss, you should come out, because if it's not quality, it should not be in your portfolio. If you don't understand these things, go for index funds, do small daily SIPs, STP. That's the best way to go about it. So one more video in the series Year of a Crisis, Lessons of a Lifetime 2020. Crisis is too precious to be wasted. What is the learning here? When there is liquidity, all asset classes will rise. High liquidity translates into low cost of borrowing, which we will see in the next session in detail. But stay with quality, because even in high liquidity scenario, it is quality which will command the premium, and your low quality stocks won't be flying high. So thank you very much for watching this series. It's a 10 video series trying to make sense of the 2020 year that was, and can we learn something out of this, is what is the broad theme of this 10 video series, year ender series from BSE IPF for the year 2020. So thank you very much for watching.